Hi everyone, my name's Darryl Panes, CEO of As Good as Gold Australia. And this evening, once again, I'm joined by my brother Brian
Thank
and
you,
partner at As Good as Gold. And tonight we interview Alasdair Macleod, advisor to As Good as Gold Australia. Good evening, Alasdair.
Good evening, Darryl. Good evening, Brian.
Good evening, Alasdair.
All happening over here at the moment, Alasdair. I've got to say that just recently, we're just back, Brian and I just back, returned from a trip to a beautiful township called Robe. If you could do a presentation in a place like Robe every night of the week, it'd be awe-inspiring, wouldn't it? Down the southeast, and it's about a 4-hour drive from here, but a room full of wonderful people who were all inspired and educated, fully understanding what's going on and wanting to do something very positive about it. So we've got the travelling bug. At the moment, we're off in 2 weeks' time, of course, to Victoria to set up our office, or our office is already set up, but we'll be there in 2 weeks' time. We open on the 14th. Yep, open for business, and we're really looking forward to that. So that's at 257 Collins Street, where everything happens in Melbourne. But Alasdair, I think that the economic hurricane that we've heard about has arrived in Australia. I think it's hit Australia. The RBA has continued to stick to their word at increasing interest rates. They've done so by another 0.25 of 1%. That's up to 2.85%. 7 in a row. Inflation now, their numbers, 7.3%. I would say it's probably closer to 17.3%, but they don't seem to be having much of an impact on inflation at all at the moment. But cost of living expenses over here, Alasdair, are through the roof, and the debt to income ratio now stands at 188%. So this is a new record for Australia. Feedback on the newly released budget there, and what we're hearing is there is no plan. They've provided us with a budget, but there is no plan. No support funding for anything because there is no money. And it's all the previous government's fault. It's all been inherited by this current government. In the US, of course, the Fed is about to confirm another interest rate hike, possibly 0.51%. So I guess my question to you is, Alasdair, where do you see it going from here? I mean, how long will the Fed continue to tighten, in your opinion? How long before they pivot and introduce, and we go back to another bout of QE? I mean, what are your thoughts? I mean, I think we're reaching that point now where, that question's being asked a lot, and I'd love your response to it.
The Fed will continue to increase interest rates, I think, until the system breaks, basically. Bear in mind that you've got inflation under the CPI in America running at roughly 10%. And your point about the cost of living, which is something slightly different, is very well made. The average family doesn't buy all the constituents in a CPI, but they particularly concentrate on vital things such as food and fuel, and sort of similar things. And it's those prices which are really rising at a far more rapid rate now. And I think likely to continue to do so through the Northern Hemisphere winter. And the problem for the Fed is that they've got very much left behind on the interest rate scene. They also make the mistake of thinking that you can control inflation by raising interest rates. No, you don't. What interest rates are is that they are compensation for depositors who increasingly realize that the currencies are being debauched. And if it was set by the markets, I'm sure that you would find that interest rates would be closer to that 10% level represented by the CPI, I think probably that rather than, let's say, the 17% that you mentioned, which is also reflected in other statistics around the world, by the way. The reason is that I think that investing institutions will be satisfied with the compounding effect of returns in the region of, say, 7, 8, 9, 10%, rather than the 17%. I think if we went up to that sort of level, that would be an enormous crisis. We're not going to get there because long before then, the system is going to break. And I'd like to point out that the last peak in the Fed funds rate was around about current levels in 2019. And that was when the Fed had to reverse course. It stopped tightening. And on March the 20th, 2020, it reduced its funds rate down to zero and instituted QE as opposed to QT of 120 billion a month. So that level is worth just bearing in mind. We can't be precise in these things, but that level of interest rates which we have today was enough to tip the whole of the US financial system into a developing crisis is something that we should be aware of. So interest rates going much beyond this level would threaten to do the same thing. In the background to this, and I've mentioned this before, is the importance of bank credit, commercial bank credit. If you look at all the transactions in GDP, they are all, apart from a few cash items, and they are minimal nowadays, they are all funded by drawing down on bank credit. Banks are now getting extremely concerned about their own positions. They are very highly leveraged. And by that, I mean the relationship between balance sheet assets and balance sheet equity. And if you look at the leverage of the G-SIBs in both Japan and in the European Union, or more correctly, the Eurozone, these leverage ratios average over 20%. Sorry, over 20 times. Let me get that right. Over 20 times. In the old days, we reckoned it was getting a bit rich when a bank's balance sheet was leveraged 10 times. It's more than double that now. And the reason it got there was that zero and negative interest rates for a prolonged period of time forced banks to increase their leverage on very tight credit margins in order to sustain their profitability. So we have this situation now where bankers are beginning to run scared. Initially, it affects the areas of their lending to which they're most exposed, and that is the financial markets. And the contraction of bank credit in, say, funding things like corporate debt, funding government debt, funding leveraged or margin accounts in equity markets and so on and so forth, all that's been reduced, and it's going to continue to reduce. It's a process which has started but not yet finished. We're beginning to see through things like loan officer surveys, which are run by the Fed, that bank loan officers are beginning to reduce their lending to the real economy, Main Street as opposed to Wall Street. So that is the outlook. The outlook is one of contracting bank credit, which immediately impacts on GDP. GDP is not in a recession because you and I and everybody we know decides that they're going to spend less, or businesses that we run suddenly decide that we're going to manufacture less. No, it's the bank credit that drives GDP. I've made this point, I'm sure, before, but it's just not understood by anyone, even in the system, not just us, as sort of lowly peons, as it were, but the people who run the government-led monetary and economic system do not actually appreciate the role of bank credit. But inevitably, what will happen is that central banks will have to pivot from talking, and that's really talking about quantitative tightening, to quantitative easing, because they cannot afford to reduce the availability of their credit, which they do through QE and through funding extra government spending and so on and so forth. They cannot afford to contract that at the same time as commercial banks are contracting their credit. So you can see that in the inflationary consequences, in that sense, are only just starting, because we now face, as the economy contracts, driven by contracting bank credit, we now face a new wave of central bank credit expansion in the form of QE and so on and so forth. And that will undermine the currencies a lot more rapidly and to a far more obvious extent as far as the currency's users are concerned than changes in the quantities of bank credit. So that, I think, is the immediate outlook. And as to your point, how far can interest rates rise? I would say that those are the limitations. The limitations are the contraction of commercial bank credit and the effect on GDP, and at the same time, the rise in interest rates will break the economy. And whether it's your economy, America's economy, our economy in the UK, or indeed in Europe or Japan, is going to break those economies a lot more sooner than interest rates should actually be, the level they should actually be. And as I said earlier, I think that our guide in this, and it's just a very, very rough guide, is that the rise in interest rates that we saw in 2018-19 in America took them to the current level and led to the collapse of the S&P by fully 1/3 between January and the beginning of March. We forget that, but the rates were similar to those we have today. The level of credit outstanding is greater today than it was then, so we can expect the impact to be happening soon.
Wow. So this is going to be, I mean, it's got to be a very hard landing, doesn't it? I mean, this is not a soft landing.
No, that's right, Darryl. I mean, the other thing you've got to look at is the effect. I mean, I've just described why banks are now beginning to run scared on the basis of their balance sheet exposure. But the consequences of the banking cohort, the global banking cohort, contracting its credit is to undermine the finances of those self-same banks. Because what will happen is that it drives interest rates up, incidentally, and this is a genuine market effect. If there's less credit, until the demand for credit drops off, interest rates are going to rise. It's as simple as that. Yeah. And this is driven by businesses, desperate. Businesses which have become desperate because they're no longer shifting product and they've got inventory mounting, they've got their costs mounting. And so they need more finance. And the bank loan officers are turning around and saying, we don't want to do this. So what happens? Increasingly, businesses go bankrupt.
Yeah.
And that means non-performing loans on the bank's balance sheets. And non-performing loans, when you're 20 times leveraged, wipes out your equity very, very rapidly. Yeah. And in that sense, just looking at the consequences for a major GSIB, which is hardly involved in this sort of lending, just look at Credit Suisse. I mean, that has really fallen on hard times. It was always seen as the gentleman's bank in Switzerland compared with UBS. UBS was seen as a bit of the sort of the nouveau riche, also rans, more aggressive bankers. But Credit Suisse now has definitely fallen on hard times. There's a rescue package going through, which is not completed. Their book value of equity, and this is market value of equity compared with the book value on the balance sheet, is running at 25%. In other words, the market is saying these shares are not worth much more than option money. And it is against that background that Credit Suisse is going to have a rights issue. It is said to be raising somewhere over a billion Swissy from the Saudis or one of their funds or something. And the balance will be done in a rights issue. The diluted effect of a rights issue at over 75% discount to book value is catastrophic. This is a rescue package, and it's not completed yet.
Mm.
Worse than that, there are other banks in Europe in exactly the same position, only it just hasn't become public.
Yes.
So this is what we see. Contracting bank credit basically will lead to major bank dislocations, banks going bust, a Kreditanstalt situation. I mean, in 1932, I think it was the Austrian bank Kreditanstalt, which in the global context wasn't a major player. Foreigners decided to withdraw funds from it, particularly the French, and you had a banking crisis, and the effects of that rippled throughout the world, I mean, particularly in Europe. That is what happens when one of these major banks gets into difficulty. Money starts flying out of them, which ensures that the difficulty becomes even more real than before it became public.
Painting a very bleak picture.
Yeah, before I ask the question, my question here, Alasdair, is that from what you just said, it reminded me of our manufacturing days in the automotive field, and we got to a staff level of about 70 people, and there was a couple of times a situation where banks said the overdraft, if we had one, I mean, we'd go in and out of overdraft. Sometimes profits weren't as good as one year as for the other. You say you have an overdraft, but they came along and said, we have to reduce your overdraft. We cannot give you the credit. And we would have 70 people, and there's no way that we could, keep those 70 people on. So, we reduced staff by probably 50% at the heat of a couple of these stages. And that's all you can do. A private company cannot keep people on just for the sake of just keeping their jobs. Otherwise, the business does go broke. You do go bankrupt. So I understand where you're coming from, and it doesn't look good. It doesn't look good at all. Alasdair, an article that I was reading that was printed by a well-known Canadian bullion dealership gave me some concern about the price of silver and gold for the next 3 years. This commodity analyst is from a company known as S&P Global. The analyst from the S&P Global stated that because of inflation, gold was only going to rise 0.4% annually till 2026, and silver downgraded to a decrease annually of 2.3% through to 2026. Now, Alasdair, when I look at the last 20 years or so, I have seen nothing but rises of between 10 and 20% average, depending on compound or simple interest. So somewhere in that 10 to 20% range, whether you look at compound or simple interest. Nothing is said from this article, from what this gentleman was saying, nothing is said about inflation causing a leap in prices, or that the printing of currency has always reflected on the price of these two precious metals. Alasdair, could you give me why, in your opinion, that this author has got it wrong?
So wrong.
He sounds he sounds like a latter-day Keynesian to me. The common problem that we have in markets is that no one who actually is employed by an asset manager, a major bank, or whatever, understands economics. They don't understand prices. I mean, it's the word that actually covers the relationship between currency and prices is cataleptics. I don't think they even know that the word exists. So we're talking about ignorance here, and it's quite difficult to comment about ignorance. But from what you have said, it is clear that this analyst, in common with all other analysts, think that all the price move comes from the commodity side. Now, that being the case, they are taking a view that there is no variation in price from the currency side whatsoever. Now, I can't comment on how he ends up with, gold is going to go up, I think you said 0.4% or something a year or whatever. I mean, this is just ridiculous. I mean, if he said it's going to, I think it's going to go down and up or whatever, I would have a bit more respect for him. But, just price history just shows that is complete nonsense. I mean, whether you're a bull or a bear, it is completely ridiculous. And not only that, but I don't think he's even thinking about the supply and demand situation, which these chaps are meant to, look at to arrive at their forecasts, particularly in the case of silver, because silver is a vital industrial metal. And if you look also at the level of stocks held in the vaults, those stocks are declining. So what does that tell you? I mean, it tells you that there is demand for silver, which when those stocks get to a certain point, even on his analysis, the price should rise very substantially. Unless, of course, somehow he seems to think that there is absolutely no change in the demand and supply situation for silver, and that's patently wrong. If I was employing an analyst like that, I would show him the door immediately. And I would employ someone who knows a bit more about catalactics, which is the relationship between prices and currencies. And someone like that, I mean, he certainly will not know the legal definition of money, which is metallic gold, or before that it was metallic silver, and technically still is metallic silver, though in practice it is less so. And when you have metallic money being effectively removed from the currency system, then inevitably what you're going to get is greater fluctuation in those currencies. And that's what we're seeing. And, there's no sheet anchor holding the value of those currencies. And governments, freed from the discipline of money, basically use their currencies as a means of funding their schemes and wars in particular, which is something we're seeing. And governments over the years have accumulated so much in the way of welfare liabilities. Those are now coming home to roost as well. So you've got all these extra expenses coming in. And from the point of view of government, I mean, a government minister has got all the levers of power and he pulls them and nothing happens. So, nothing happens. So what does he have to do? Well, he has to somehow get more funding. And where does it come from? As taxpayers, we can no longer afford our governments. So what do? Well, they have to go out and print it. And that actually is what we're seeing. And it seems to me that this analyst is horribly ignorant of these very, very basic affairs, situations. Anyway, and also he will be completely unaware of any human sentiment. He's probably got some sort of model, which works rather like, central heating pipes running around your house. You've got pipes going here, there, you turn off a radiator here and you turn another one on there and you adjust the heat. This is what they do with economic modeling. It is actually like a glorified plumbing system. But we're talking about not, a mathematical or a mechanical relationship between different parts of the plumbing system. We're talking about human action and what drives the desires and fears of humans. That is actually the thing which nobody can quantify, which is why an analyst like that should be sacked because he's not doing his job.
Yeah. Oh, I totally 100% agree with that. 100%.
In fact, I fully expected a response of that nature. I would have been disappointed at it not being.
Well, there's two things here, and sometimes we don't say what we really feel. But I think there's a lot of propaganda coming out of news reports, really a lot of propaganda. And the other thing is maybe some of these analysts do get paid off. Now, that's about as much as I'll say here, but maybe they're working for somebody else and they've got an agenda. But anyway, I have to leave that one alone.
Brian, I can just add a little bit to your comment. The way it works is that if a journalist does not go along with the government line, he is excluded from any background briefings. So he knows that while he can criticize the government, he must go along with the basic suppositions, if you like, that government have about why they are pursuing a particular policy. And it means that the mainstream media are always on side. And I don't know about in Australia. I think it's probably very similar. But in this country, the press here is absolutely on the side of war against Russia, to support. I mean, to say, a direct conflict to Russia, I think would be wrong. But Russia is demonized. I'm not saying whether this is right or wrong. In this country, I cannot access any Russian websites to get a view from the other side.
Yeah, interesting.
Now, I would have to say that I don't believe anything any government tells me. So but you can see how this, the propaganda is not just with the media. It is through the whole system. And we are so used to it that we don't actually understand that it's happening anymore.
Yes.
Yeah.
And I think we've got to, this is why it's desperately important for anyone to have their own independent analysis and thoughts, irrespective of what governments tell them.
It is interesting you bring that up before I go into the next question. I always looked at, in the 60s, the Vietnam War, and because too young back then, but looking back now, and I know that gold standards were dropped to fight wars, but you look at Vietnam War, the Americans obviously spent millions and millions, probably billions back then, to keep that war going. And then in the 70s, the massive inflation took off because of the amount of printing of money. And I was only looking at a site called usdebtclock.org the other day. Now, at the beginning of this year, it was it's pretty well steady around 28 point something trillion for the US debt clock. And I only looked at it the other day and it's up to 31 trillion. Yep. This massive increase of expenditure. And I can only think of one thing. There's a war going on and America is trying to be the policeman of the world again. All right, to my next question. Alasdair, this is a good little article. Alasdair, in an article that you wrote and was posted on King World News on October 28th, just a few days ago, you said, with commodity prices generally subdued, gold and silver were quiet backwaters. It's like watching paint dry. I totally agree with that. But the technical situation is becoming potentially explosive. Can you explain potentially explosive, what you meant by that?
When I say technical, I'm not talking technical analysis. I'm talking about the technical position in the market. So I just want to make that clear. We have, if you look at the gold contract on COMEX, the swaps, who basically, the majority of them are bullion bank dealing desks, as it were, are short to the tune, I think, of around about 70,000 contracts, and which represents 7 million ounces. You can work out how many tons that is. I can't off the top of my head.
That's all right.
I'm too old to do that sort of mathematical exercise. And at the same time, this is the interesting thing. At the same time, the hedge funds are also short. I can't remember the figure, but it's something like 11 or 12,000 contracts. Now, for the hedge funds to be net short is very unusual. It's only happened about 2 or 3 times, I think, over the last 10, 15 years. The difference, I think, is in what they call the non-reporteds. Now, the non-reporteds still remain persistently long. We know that hedge funds are not interested in taking delivery. They're in and out traders, basically. So the people who are standing for delivery are the other reporteds and the non-reporteds. The non-reporteds being a sort of tiny, the small butt, if you like, of the remainder. And these are the guys who are standing for delivery. And COMEX is not meant to be a delivery market. I mean, the idea that you can have delivery is simply to tie the futures price to the physical price. And most of that actually happens in the exchange for physical, which is basically positions being swapped between COMEX and the London bullion market, forward market, as it were. So, the problem is that as far as the bullion desk dealers are concerned, they want to get the price done. But meanwhile, the physical is running out of the door. And the World Gold Council reported that so far this year, central banks have taken delivery of another 400 tons of gold. This is not a trivial amount. It's the largest annual increase, and we're not even done with the year yet, that we've seen for some considerable time.
Right.
These are the smaller central banks. Now, that is interesting. Why are they doing it? I mean, I suppose partly the reason is that they have seen America and NATO's currency restrictions against Russia, and concluded that the only form of exchange reserves that they should really hold, which is safe, is gold. You could argue that with a lot of these central banks being involved with either the Shanghai Cooperation Organization, or as India is now, and Iran is about to be, or the Eurasian Economic Union, or BRICS. And in the case of BRICS, Saudi Arabia is talking about joining in 2023. This is actually the majority of the world population, and it's the central banks away from the Fed, the Bank of England, the ECB and its network of national central banks, the Bank of Japan. It's not those guys, it's everybody else. And I think this is a very clear signal that for whatever reason, central banks, not in this, G7 network, as it were, are actually running scared of the global currency situation. What this means, and this is the technical bit, is that there is a developing shortage of physical stock. And we've seen that the stocks in the London bullion markets, vaults, have been draining, and also silver as well. So, how is it? What are these bullion bank dealers hoping for? Because the people who should be long are no longer long; they're short with them. I think you'll find also that the producers are finding it increasingly expensive to hedge, and will do so because on the next price rise, what will happen is that while they've got the physical, and they work out when they can deliver the physical from their mines or from their refineries or from their whatever it is, they can work out when they can deliver it, and they cover it forward so to take the price risk out of it. But what happens is when the price rises, they have got calls on their shorts, margin calls on their shorts. And this is something that back in March this year drove Trafigura into refinancing itself because it couldn't handle all the margin calls on all the commodity positions that it had in the futures markets. They were trying to manage risk on what they could see being delivered. What they must be hoping for is to make the ordinary person who holds ETFs, and particularly the GLD ETF and the SLV ETF, to make them feel particularly discombobulated, upset, bearish about the non-performance of gold and its apparent continuing to slide down. to get them to liquidate their positions because they want that physical. They've got to have that physical. So what we're seeing is a managed position which technically could come unstuck at any moment now. Interestingly, there was the LBMA conference in Lisbon was held 2 weeks ago, I think. And as they usually do at this conference, they get opinions as to where the gold price is going, where the silver price is going. Well, interestingly, they reckoned that they were bearish on the gold price, saying it would go to 1840. Is that bearish? Where are we? We're about $200 below that. Anyway, that seemed to be the story. But they were a lot more positive about silver because they could see that there was going to be demand, well, whatever. And also, they were referring to the tightness of the market. Bear in mind that these commentators are basically short gold and long silver. So that, I think, informs you about the value of that opinion, which I would put at zero.
Okay.
Watch what the central banks are doing. The central banks are accumulating real money because they're running scared of pretend money, which is otherwise known as currency. And I think that is really the way I would answer that question.
Right. Before Darryl moves on, I will say that in the physical market, as good as gold has got a number of suppliers. And one of our largest suppliers is running at 12 weeks delivery. For us to bring in gold bullion, physical gold bullion, we're having to order 3 months in advance. So, that's what's happening in the real world, not the paper world. Yeah.
Oh, very much so.
Darryl?
Definitely tightening. My question, last question. Where to with gold and silver, Alasdair? I mean, we've got physical gold sales worldwide at the moment are up 28% year on year. And these stats came from the World Gold Council. Saudi Arabia wants to join BRICS. This is really big. The Egyptian central bank governor wants the pound backed by gold. We've got wars. We've got inflation running rampant.
Yeah.
We've got the world in economic chaos. There's an awful lot going on at the moment, and it's a perfect environment for gold. Where to with gold and silver from here? Just moving forward, Alasdair, your thoughts?
I don't look at it the same way that most people look at it. And indeed, I don't look at it the same way most gold bugs or silver bugs look at it. Actually, what we're talking about when we're talking about the rising gold price or the falling gold price is changes in the purchasing power of currencies with respect to gold. And therefore, by implication, with respect to the generality of commodities which we consume one way or the other. And therefore, really what it is about is the loss of confidence in those currencies. And under those circumstances, I would see not only the purchasing power of currencies declining at an accelerating rate, which is what I would expect, hastened, I must say, by the contraction of bank credit and the response to that by the central banks. But also because gold is in such short supply relative to two things, relative to the global population and relative to the global population that hasn't got any, and also relative to the quantities of currency, which seem to be accelerating. I mean, you were saying that, looking at the debt clock, you've gone from 28 to 31 trillion dollars, in a short period of time. That's just one example, if you like, of what is actually happening to the debasement, the debauching of paper currencies. So I think it's going to be a combination of things. And my favorite story, which I've said to you before, is what happened in 1923 with property prices. I mean, foreign students out of their allowance from mum and dad studying in Berlin could buy rows of houses out of their monthly allowance. You could buy a really fantastic home in a swanky part of Berlin for 5 ounces of gold, which was about $100 in those days. So what you do see in those extreme conditions is a complete loss of confidence, if you like, in an unanchored paper currency. I mean, that same property, might be worth a trillion paper marks. Yeah, and before the war, you could have bought it maybe for 300,000, paper marks, because a paper mark was then convertible into gold. So it's a combination of that, and also the shortage of real money, which is physical gold, and its very close cousin, physical silver, means that the purchasing power of those also rises very substantially under those circumstances. We have yet to see that. We have yet to see public confidence being undermined in the paper currencies. They tend to be rather late to the game. You see it first of all in the foreign exchanges, and the foreign exchanges in this Keynesian world, neo-Keynesian world, think that safety is actually to be had in cash dollars. So what do? They're selling yen, they're selling Chinese yuan, they're selling euros, and they're selling sterling, all to go into the dollar. And that's basically what they've been doing. But the dollar itself, to pick up what you said, Brian, is, it's the best of a very bad bunch. I don't think that's quite what you said, but, it's the same thing.
I remember.
It's not going to be very long, I think, before you find that particularly commodity dealers start viewing the paper currencies of the West as being something they would rather not have. And so balances, I think, will be reduced, not just of euros and yuan and yen, but I think also the dollars as well. That is going to start to happen. I think what we're likely to see is a global economy which is far more commodity oriented to get away from collapsing paper currencies. And of course, the public tend to be fairly late in the game in understanding this. But there are two sections within that. I mean, the people that you deal with are very similar to the people that your sort of competitors in places like America and Germany and France deal with. They're seeing, let's call them old-fashioned individuals who just don't like what they see and think they better have some gold and physical gold and put it under the bed or whatever. That is definitely increasing. But the financial system, the majority of people just don't actually realize this, and they will come to understand it late. But they're beginning to react. What they're doing is they are reducing the amount of liquidity they hold in their banks, bank deposits, and so on and so forth, relative to their, to the goods and services that they buy, and particularly goods. I mean, we run out and we stock up on things like, which we don't really need, like toilet paper, like, tins of bully beef, whatever, something that you can put in the store cupboard, not for immediate consumption. Your store cupboard is probably groaning because it's full. Why? Because you just know the prices are going to go up. You haven't actually worked out why the prices are going to go up. You just know that they're going up. So the next stage is you begin to understand why prices are rising. It's not because the bully beef and the tins of baked beans and the toilet rolls are rising in price. It's because paper, paper money is just buying less and less and less. And once that penny drops, then there is no hope for the paper currencies. So as to where gold and silver goes, I never make forecasts. And I think the important thing to understand is that physical gold and physical silver are not investments. They are money. And you hold money, you hoard money to spend. And in that sense, the price that you pay measured in fiat currencies is actually immaterial. Ordinary people who don't understand this are prone to be shaken out of the situation, and they will only realize too late when it'll be very, very difficult for them to acquire the gold and silver that they need to keep body and soul together.
Yeah, I'd agree.
Yeah.
It's typical. Jim Sinclair would say, become your own central bank, clearly. And I am 100% supportive. I mean, all central banks around the world own gold, but no governments, in particular, and central banks ever talk about you owning it, do they?
Oh, no, they talk you out of it.
Talk you out of it, in fact. Exactly. So become your own central bank. Take control of your economic life. Peter Daniels would always say, I do not care what poorly executed economic decisions are made in the world tonight. Tomorrow, I'll still be able to party. Why? Because he owns gold. And I talk about Peter Daniels, we talk about him a lot. But interestingly enough, there he has 2 sons and a daughter, and they've created a dynasty. The dad, that is Peter Senior, has educated his children into gaining a greater understanding, or a full understanding, of the purpose of owning precious metals. They've done so, and now guess what? They are educating their children, aren't they, into doing the same. It's like some of the Russians, some of the powerful families in Russia, it's a dynasty that they build, and they invest in 3 areas: precious metals, fine art, and land. They keep it pretty simple, but generate enormous wealth in the process, don't they? Not complicated.
No, not complicated at all. It's just one third,
Exactly.
and you'll be all right tomorrow.
Exactly. Exactly. Now, and Egon. I mean, what does Egon have to
Well,
say?
you know, we talk about two people over here, Alasdair. Ray Dalio and Egon von Grass. And Ray Dalio says, now Ray Dalio is one of the best investors, of all time. And but he says, why? He says, please give me a reason why you wouldn't have at least 5 to 10% in gold in your portfolio.
Yep.
He's worth $20 billion. He's talking $2 billion worth of gold,
Yep.
and he's a great investor, so he knows what he's doing, but he still has 10%. Egon von Grass, how much should you ever have? How much should you have of gold and silver? Whatever you can't afford to lose. And that's a great answer to that question of how much you should have.
Yeah, a little different to the CEO of the Perth Mint. We've told the story before. Alasdair, look, any closing remarks that you would like to make just before we close up tonight?
Yeah, I mean, the whole of the system is, I think, on the verge of breaking. I'm calling this the great unwind. And what I mean by that is that all the distortions of declining interest rates from 1980s or the mid 1980s to last year, all those are going to be unwound. And I think that the unwinding of those distortions will come as a tremendous shock to the global financial system and global economies. What we're saying, I think, or what we're questioning is what will be the survivability of fiat currencies in that environment? It's not going to be pretty, but think of it as the great unwind. And that is what any bank has got to survive. I mean, I've been analyzing the OTC derivatives. And by far the largest element of them, at something like, I think 407, it's just short of $400 trillion is interest rate swaps. Now, what the banks have been doing over the years is they have been facilitating people from pension funds to properties to take a fixed rate of interest or to pay a fixed rate of interest over a floating rate. And there has been good margin in this for the banks. Now, imagine what happens when instead of having declining interest rates over a long period of time, they start rising, which they're beginning to do. There will come a point, I think, where the banks find that business no longer profitable. And very rapidly, we're talking about 2/3 of a 600 trillion market. And bear in mind that the global economy is estimated to be just a little less than 100 trillion. So we're talking about 6 times that. The interest rate swap market is going to dry up very, very quickly. So what you're facing is a very severe contraction of global OTC derivatives. And it won't just stop there. I think you'll find that lots of banks will get into enormous difficulties as those derivative transactions begin to unwind. And it'll be very, very expensive for any bank trying to get out of existing derivative transactions, because a lot of those interest rate swaps are for more than a year, and quite a lot of them are even for more than 5 years. So, these are not trivial amounts, or not trivial in terms of their duration. So, there's quite a lot which is sort of happening, which the public are not really aware of. I mean, who knows what an OTC derivative is in the general public? They've got no idea at all. And even sort of, if you like, investment management analysts are only vaguely aware of what they represent. But this is the core of modern banking, and that core is beginning to fall apart. It really is. So, I think we're in for really difficult times as far as the major banks are concerned. I mean, a lot of the smaller banks are not involved in this at all. I mean, if you look at a regional bank in, I don't know, Perth or somewhere like that, you'll find that, they lend to local businesses. They're not really involved. I mean, they might offer a little bit of credit to, sort of local stock market speculators, but that's a very minor part of what they're doing. But nonetheless, I mean, the effect of this, I think, it's not just the big banks, but it's the systemic risk from those big banks toppling over the edge. They're going to have to be rescued. I mean, the best assumption we have is that they will all be rescued. A more realistic assumption is that the rescue packages, which are bound to be agreed at a G20 level and all the rest of it, may fail at some point. That's a far more likely situation. But even if the central banks discharge one of their primary duties effectively, which is to protect the public, protect their economies from commercial banking failure, then this is going to involve a massive, massive expansion of the quantity of credit from the central bank. And then I think you find that the people who don't understand gold, who don't understand what's actually happening to what they think is their money, but actually more correctly is currency, they will then wake up. And we saw exactly the same thing with John Law in France in 1720, when his Mississippi scheme started failing. It was the currency, it was his livre, his unbacked livre, that collapsed. And the other thing we ought to bear in mind with that is that John Law ordered the confiscation of all specie, jewelry, everything else. And you had the sort of forerunner of gendarmes knocking on your door, getting you to turn out any valuables that you might have. Why? Because John Law didn't want to see anything that competed with his livre. And this was what happens when currencies fail. Yeah. Our governments will behave in completely ridiculous ways. They will react to the developing deterioration of their own currency situation by making the thing far worse. But we as individuals will risk losing freedom in the process. And that is something you've got to keep your head down on. Just as a general observation. These are not going to be easy times. Anyway, hopefully, hopefully a crisis won't occur before we talk again.
Sure.
Yes.
Yeah, absolutely.
Very wise words.
Yeah. And I would say right now that everybody's listening to this, get your house into order. Right. Remove the debt. Buy as much gold and silver as possible, because you'll be needing real money, not the paper stuff, but the real money. Just get your house in order. Yeah.
After those last comments from Alasdair, I thought of Charlie Tremendous Jones at that point. And Charlie, we refer to Charlie quite often, Alasdair. He is no longer with us, unfortunately, but he was a wonderful American, motivational speaker. But he used to say that in 10 years' time, you'll be in exactly the same position you're in right now, apart from two things: people you meet and the books you read. And the information that you provided tonight was outstanding. And it's an illustration of what Charlie was really talking about.
Absolutely.
You know,
Yeah.
and when you've got an opportunity to connect with somebody like Alasdair, and you can do it regularly, I mean, with the internet or YouTube today, just take it full advantage, because it's a wonderful asset to be able to connect with people like Alasdair.
Yeah.
Take advantage of the information.
Exactly. I mean, it's not just listening to these broadcasts, but go to goldmoney.com, where Alasdair is writing for. Every 10 days, you put out great articles. And, you know, if you read these articles, you start to understand what's going on out there.
Absolutely. Yeah. Alasdair, we're privileged to have you as an advisor to As Good as Gold Australia. We really appreciate your input. It's outstanding, and we'd like to thank you again tonight for that, and look forward to your contribution for many years to come. Well, we'd like to think so anyway. So thank you again, Alasdair. Really appreciate it. And we'd also like to thank our viewing audience, our subscribers. Until next time, stay well, stay focused. Goodbye for now.
Goodbye for now.